This is Jonathan Mickles with the Strategic Multifamily Investing Podcast, and today I have with me a returning guest, Mr. Charles Seaman. How you doing, Charles?
Jonathan, it's a pleasure to be here. Thanks for having me back.
Absolutely, man. I see that you have joined Team Bald, man. That's cool.
I have. I decided the hair was kind of leaving me anyway, so I figured I may as well beat it to the punch.
There you go. There you go. And then you complimented with a beard. So yeah, your beard game is on point. You're doing good, man.
Thank you.
Yeah. All praises to the patron saint, Michael Jordan, making the ball
Absolutely,
great.
yes. If I can be half as good as he is, I'm doing pretty good.
There you go, man. There you go. Well, I think that you are very close to that when it comes to underwriting. You know,
Well, thank you.
you've done a lot.
Certainly not at dunking, but yes.
You have done a lot for the community, man. And I want to say thank you again for what you've done. So, I met Charles because Charles was doing free underwriting classes for anybody who was interested in doing or investing in multifamily or trying to get started in multifamily. And a lot of people that I've known have grown up and have done beautiful things, have all come through Charles's class. So, Charles, tell us a little bit about your background with underwriting real estate, multifamily deals, or just even residential. How
Yes,
did you get your start?
absolutely. So, I mean, for me, I've been in commercial real estate since 2005, and at that point, I was really just working for a gentleman who was a commercial investor and just learning a lot along the way. And fast forward to 2017, I started in multifamily at that point, really focusing on that part time while I was still working my full time job. And then 2019, I made the plunge and went to a lend. So it's been a lot of experience, a lot of hours, a lot of mistakes, and learning from those mistakes to figure out how to tweak things. One thing I would always tell anybody, whether it's underwriting or anything else in this business, is that you want to learn from the mistakes. And the way that you're going to become a better underwriter, the way that you're going to become a better operator, the way you become better at anything is by making mistakes and then learning from them and tweaking things so that way you're not making the same mistakes again in the future.
Let's talk about one of the first mistakes that you made then. I mean, what was one of the first mistakes that you made that you learned from?
Well, geez, there's been a lot of them. Now I have to put them in chronological order.
Well, just
Well,
pick one that you like that maybe you learned the
absolutely.
most from. Okay.
So the first one I really learned from was trying to do things differently than the way people suggest that I do them at the beginning. And when I was first coming up in the syndication space, people told me pick a target market. I was resistant to that, so that took me longer to find the deal because of that.
What? Okay. Why is that? Let's talk. Let's double click on that. What do you mean? Why was? I mean, a deal is a deal is a deal, no matter whether it's in North Carolina or in Florida or in Texas. Yeah? No?
There's a lot of truth to that, but here's where the difference comes in. The difference comes in that most times the way you're winning these deals is through relationships. So you're winning them through track record, you're winning them through relationships. At the beginning, when you have no track record and you're diving into new markets and you don't have relationships, it's going to take you longer for two reasons. One, you need to go out there and build relationships. You need to meet new brokers. You need to meet new sellers. You need to meet people who are going to vouch for you when you're putting an offer in to try and get a deal. The second thing is you also need to spend time learning the market. So the more time you spend learning the market, the better chance of your competition beating you. So you're usually winning deals for a handful of reasons in this business. One of those reasons is speed. If you can outperform your competition and get a result faster than they can, a lot of times you can wind up winning those deals. So by jumping from market to market, you're always spending more time learning the market and building relationships, and that gives you a disadvantage versus somebody who's already in the market and aware of those things.
So let's talk about the speed. You said the more speed you may have, you may be able to outperform them, right?
Mhm.
So you gain speed by having what in place, or what are you doing that gives you more speed?
Yeah, great question. So by looking at more deals in the same market, you start to become familiar with what's typical in that market. So you become familiar with what you can actually charge for rent. You become familiar with what things cost. one of the biggest things that I always find, I always take exception with when I hear people say it is how you want to shoot for that 50% operating expense ratio. And I think that sounds great if you want to give a real simple instruction, but I don't think it's always practical. And the reality is things are going to vary from market to market. And a lot of times I think a better metric to focus on is the per unit expense number. The challenge with that is when you teach somebody, it's not so easy to teach because it varies from market to market. So that's where it helps having that expertise and letting you know what something is actually going to cost so you can factor it into the underwriting and be faster with it.
So then let me ask this question with the 50%, rule of thumb, which for some people that may be the first amount or first set of speed metrics, if you will, that might help you to be able to underwrite a deal very quickly, right?
Yeah.
50% operating expense ratio. What does that mean? Okay, let me double click on that. So actually, Charles, why don't you tell us? Since you are
Yeah.
the underwriting expert, I won't go into.
Great question. So when people refer to the operating expense ratio, they're always taking that ratio as a percentage of the operating income. So let's just use simple numbers. So let's say, you have $10 of income and people are telling you that, okay, you should be spending 50% of that on your expenses. So then the assumption is that out of that $10 of income, five of it's going to be expenses. Now, sometimes that can be true, but I wouldn't say it's a black and white thing where it's like, it's gospel. It varies from market to market. It varies based on the asset class. Let me give a practical example.
Sure.
So let's say if you're looking at two 100-unit properties in the same market, and for the sake of the example, we'll say they're both C-class properties, and we'll say that they both have, uh, you know, let's say similar size. Let's say they're both 100-unit properties. Now, let's say one of those properties has an average rent of $900, and the other property has an average rent of $1,000. In most cases, is there going to be a difference in how you run those properties from an expense standpoint? Just because you have lower rents doesn't mean it's going to cost you less to fix things.
Right. I would assume that it's the same, especially from a management perspective, because
Right.
property management, you're still going to probably want the same type of property management that you would from one to the other.
Exactly.
And the one
And the
with,
same staff requirements and the same utility costs. So just because you charge lower rents than the competition doesn't mean that the utility company cares about that. They're not going to say, oh, well, let me give this guy a discount because he's charging less rent. They're still going to charge whatever their rate is. Same thing with the tax assessor. They don't care, what your rent is necessarily. They want their money and they're going to get it either way. So that 50% number can be reasonable, but it's really just like a back of the napkin thing versus something I would recommend people factor in as gospel.
gotcha. So then so you would take the property with the lower rents than one with the higher rents at this point in time?
Not necessarily, but underwriting the expenses is really the more important piece to take away there.
Okay.
And being able to have that speed, that comes from knowing the market better. So if you're just diving into a new market each time, it's going to take you time to become familiar with that. And if it's an on-market deal where you have a couple of weeks to work it, sometimes that's not necessarily a bad thing. But if it's an off-market deal where speed is typically very important, sometimes that extra couple of days it takes you could be the competitive advantage that somebody needs to win that deal. I actually did that on my second deal. It was in a market that I knew better than somebody who was out of market, and I really didn't have much of an advantage otherwise. But I simply was faster to jump on it than they were because I knew the market better, and because of that, it allowed me to win that deal.
Now, you already had a GP team in place when you went out after them, yes?
Yes.
Got it. So that's a very important thing also to have speed because there are a lot of people who are underwriters who don't have a team already. How would you advise someone to kind of go after a team before they start going after properties and start underwriting?
Yeah, great question. So, this probably goes into another mistake.
Okay.
Putting together the right team. And it's a mistake I've made a few times, not even just once. So you learn, but you learn different things. And, one of the things that's important is you need to honestly assess one, what do you bring to the table? And two, what do you need? And then three, how do you make money? Because one of the things people don't really think about probably enough in this business is how they make money. Why is that important? So you want the investors to make money. That way they invest with you again. But here's the challenge. If you're not making money as the operator, then ultimately what happens is you wind up diverting your attention to something else that's going to be making you money. And because of that, something has to get neglected along the way. And it's probably the thing that's not making you money. So why do I say that? Well, let's say if you go out and you build a GP team and you have 10 partners. Well, all of a sudden that $200,000 or $300,000 acquisition fee, while it still is very helpful, it doesn't go as far if you have 10 partners. So when you see that illustration, yes, that's great if that's going in your pocket, or if you have maybe 2 partners. But if you have 10 partners and you're each doing different things, all of a sudden that number cuts down a lot more.
But getting the 10 partners a lot of times is a factor of, hey, I don't have enough money. I don't have money myself, which a lot of GP teams, really don't have. But as I understand from a mortgage perspective, they want you to have at least 10% of whatever the raise is, or 10% of what
Yeah,
the purchase price is, in the GP team. So you need somebody who has deep pockets in order to be able to cover that if you
very true.
reduce the number of people that it's on the GP team. Yeah.
Yeah. So why is that important? So what you said is 100% true, and it's something that a lot of people don't talk about. So I'm glad you're kind of pulling back the curtain on that. Um, because we all only have a finite amount of capital, even though we may like to imagine that we have, hundreds of millions and billions of dollars. The truth is most syndicators don't. Some
Right.
have millions, but when you do sizable deals, those millions can go pretty quick. You can only get so many deals before you deploy them. So what does that mean? So you need to figure out what side of the equation you're on. So in the GP team, the roles that you're typically being compensated for are finding the deal, raising the capital,
Hmm.
sponsoring the loan, putting up the risk capital, which is all the money prior to the closing, and the asset management. So most teams are usually divvying up the pie between those roles. So what I would tell anybody, especially if you're brand new, when I say pick the right team, I think naturally a lot of us think like, oh, let me go out there and find the big team. I've done that. And there's some good things to it, but there's also challenges. The challenges are that the pie all of a sudden gets a lot smaller when you have that many more partners. So I think the question you need to ask yourself, for anybody listening here, is one, how many roles can I fill? So
That's
if you're
good.
not finding the deal,
Yeah.
can you do something else aside from finding the deal and keep a bigger piece of that pie? And then when you're going to search for team members and partners, how many roles can they fill? So if you're getting somebody who's filling half of one role and you need to bring somebody else in for that, could you find one person who's maybe going to do the risk capital and loan sponsorship? So that way it's less partners and everybody's keeping a bigger piece of the pie. So it actually makes more financial sense. So finding that team is important. Just think about what you have and what you need, and do an honest assessment of what roles you could fill and try to keep the partners to a minimum.
What I think would probably be really good if you and I, just spitballing here, sit down and put together maybe an ebook even on here are the roles or here's the team that you need before you actually go out and start, underwriting deals. I know there's a lot of groups that are out there right now that do that. Um, so that actually do that. They go and underwrite. And it's like, okay, great. We need to go get a mortgage, assessment. And so you send it off to the mortgage person and then you're like, I need to get a, you know, insurance, quote, and you go do that. And then the first thing the mortgage person says is, who's the person who's going to sign? So
Right.
you don't have the right people in place in order to do that. And I've done that a couple of times where I
I
found,
think a lot of us have. The first deal that I was ever close on winning in the syndication space, that was when I started building sponsor relationships. So that in retrospect, that's not the time. That's another mistake. That's not the time to go out and build sponsor relationships. you don't go around and ask somebody you don't know to sign on a multi-million-dollar loan for you.
There you
You
go.
want building those relationships beforehand, so that way they feel confident in you and they're willing to sign versus just seeing a deal and basically putting their reputation and their name at stake for somebody they don't truly know.
Exactly. And I think, this isn't necessarily exactly where we wanted to go, but I promise you this is going to help somebody because I've had a situation that, every sponsor, that you come across who has money is not the right sponsor either.
Right.
Because a lot of times if they are, oh, I've got $1 million or whatever, but I want the entire deal and I want to have control over everything in the world. And if you're not willing to do that, then, you need to find the right sponsor. I think,
100%, you nailed it. But you know what? I know you mentioned that we were going in a different direction. Why don't we go back to the intended direction? I know you had some good stuff you wanted to share with
yeah,
today.
yeah, I know. So the reason why I wanted to ask you to come on again was understand what's going on right now in the market. At the time of this recording, we're at August of 2024. We're in an election year, right? There is the potential of the bonus depreciation, which a lot of people really got involved with, you know, um, during certain presidency, and it may go away, but depreciation is still there. It's still a big thing. Um, and then, of course, you got the insurance, and are we going to cut rates? And on the residential side, which we're not talking about right now, there's a whole upheaval with realtors in and of itself. And I just kind of want to understand. And then there's a lot of people the last couple of years, and this is the big piece from financing standpoint. You couldn't purchase a multifamily deal unless you were doing bridge debt. So explain to us what bridge debt is and how it's impacting us right now. How about that?
Absolutely. So bridge debt typically is short-term financing. The reason it's called bridge debt is because it's supposed to bridge you from the property being in its current condition, which most times is going to be an unstabilized property, until you get the property stabilized and either refinance into permanent debt or you sell it. Now, that's what bridge debt's supposed to be, and I think that's how many people are using it now. But I think you have another question on mind, so why don't we get into that one?
So they're getting into trouble now because they had to get bridge debt. Why did they get bridge debt instead of long-term debt? Let me ask that question.
Great question, and that probably sums up most of the issues that we see now in the multifamily space. So let's go back a little bit and let's go through history. So in 2020, beginning of the year, there was a lot of uncertainty once the pandemic hit, and there was a lot of fear in the market because people didn't really know what was going to happen. And right now I'm speaking specifically about the multifamily market, but that obviously that applied to many markets. So as that happened, in the summer of 2020 and the fall of 2020, while there was still a lot of uncertainty, there was also a sense that, okay, we're going to come out of this and things aren't looking so bad. Maybe they're not as bad as we thought in February or March. Maybe the economy's not going to tank. And all of a sudden, you saw a lot of syndicators come into the multifamily space. And you also saw a lot of larger players who historically had invested in things like office and retail come into multifamily because they were turned off by some of the other classes they were investing in because of what happened during the pandemic. So all at once, you had a lot of money, a lot of new money pouring into the asset class and really boosting values. So from the end of 2020 to the end of 2021, probably had the largest year-over-year property value increase in U.S. history. And that's actually single family or multifamily, either one. So what does that mean? Well, what it means is as 2021 went on, property values were increasing at an astounding rate. Give an example. There was a property in Charlotte, where I live, Charlotte, North Carolina, that I looked at, a C-class property that we actually had under contract for $115,000 a door in May. We wound up dropping the contract because during the due diligence inspection, we found that there was going to be more CapEx work than we had thought.
Okay.
and retrading wasn't an option. The seller wasn't going to go for it, so we dropped the contract. And about 5 months later, maybe not even, I looked at another transaction literally on the same block as this property. So, and this is a similar vintage, so it's like an actual comp. And it sold for 165,000 a door. And that's how fast prices were shooting up. And and I was joking around with my partner at the time. I said, boy, even with that extra CapEx work, looks like we could have done pretty good on this one. You
Yeah.
know, I mean, obviously, it's always clear in hindsight who would have guessed in 4 months you'd see properties go from 115 a door on a block to 165 a door. So very interesting. And, it was a time in the market where what I tell you was an extreme seller's market. It was extreme. There was another deal in Charlotte. I remember this one was a better asset, a B class asset, decent area. Some institutional players that were probably looking at it. The broker that was selling the deal, and this is just to give some perspective for everybody who's brand new and maybe wasn't looking at deals at that time. Uh, Most times in a seller's market, the deals aren't going to be priced. They're not going to have an asking price, but they'll have what's called pricing guidance or a whisper price, which is basically reaching out to the broker and getting an idea of kind of where the seller's head is at.
Right.
So for this particular property, and this was August of 2021, the guidance was $240,000 to $250,000 a door. Now, okay, it's a B class asset, strong market in Charlotte. So what did it actually sell for? It sold for $290 a door. So when you put that in perspective, and this was a 309 unit property, so they were targeting something like 78 million. They sold it for 91 million. Okay, so why is that relevant to what I'm saying? Well, what happened is that people started paying crazy, and when I say crazy, I mean absolutely absurd prices for deals. And pretty much anything purchased in the second half of 2021 or most of 2022 would probably fall into that category.
Yeah.
So what does that mean? Well, why couldn't you get long-term financing? Well, the answer is you could, but the leverage would have been very low. Why? Because lenders aren't in the business of taking excessive risk. And what they did is they looked at it and they were saying, okay, it just doesn't make sense at this price. We're only going to loan 50% LTV, loan to value for anybody brand new.
There you go.
So what does that mean? So that means the person who's buying that deal either has to raise a lot of capital, or if they're using their own capital, they got to put a sizable chunk in. Now, in retrospect, that would have probably been the smarter move, but it's always clearer in hindsight. Keep that in mind. So September 2021 was the exact month that I remember Fannie Mae and Freddie Mac no longer sizing to max leverage on any deal I saw. And I thought to myself, does that mean these deals are all overpriced? And the answer in retrospect is yes, they are. But at the time, bridge financing was there, and a lot of buyers were using it to get deals done. So,
what was the leverage, if you will, on a bridge debt?
Great question. So, the leverage on many of those was anywhere from 70 to 80% of the purchase price, plus 100% of the CapEx.
Oh my gosh.
So that means the leverage, like once you factor the CapEx dollars in, on most of these deals is north of 80%. There's some I see that are even like 90, which is scary when you think about it.
Right.
And for somebody brand new, like you might be thinking, oh, I don't have the money, 90% sounds good because there's less money for me to come up with. You may think that, but what I'm also going to tell you is it's more risk. Well, while it is nice to get a deal with less money out of pocket, it is very, very important that somebody on your team, be it you, be it somebody else, maybe everybody, has some money, because if you don't, you can easily get hurt very badly on these deals, which will probably fast forward to where we go.
So why is that a problem if there's less money coming out of my pocket? I mean, if something costs $100 and one bank is willing to give me $50 loan, and another bank is saying I'm going to give you a $90 loan to buy that $100 thing, what's wrong with that?
Okay, so what's wrong with that is, so for everybody who's used to the single family space, and maybe you're thinking, oh, I might do that on like a seller finance type of situation. Here's the difference. A seller finance deal, you can negotiate the terms with a bit. So you can say, okay, maybe we'll defer part of the interest until this date, or maybe you talk them down to a lower interest rate. Uh, when you're dealing with a conventional lender, you can negotiate the terms a little bit, but you're not going to tell them, Mr. Lender, can you defer half of your interest payment until this date? They're going to tell you, take a hike. So what happens is you have increased debt service. Essentially, your mortgage payment is higher every single month. So now instead of paying on that 50% LTV, you're paying on 80. What does that do? Well, here's the challenge. If your property only has, let's again, use simple numbers. So let's say if it has $100 of cash flow of net operating income, but let's say your mortgage is, let's say 60 bucks on the lower one and maybe 85 bucks on the higher one. Well, now you're using that much more cash flow to pay the mortgage. And that's assuming your net operating income stays the same.
So then so you're paying a higher mortgage. But some people say, well, and this is how some people actually did well. They were saying, well, I could force the rents, because rents have been low, for an extended period of time. So I can get more rent because, again, I'm going to use the CapEx, which is called capital expenditure, to improve the property and get more rent from that thing. And so now I'm able to afford that higher interest payment. Yes?
It sounds great in theory, doesn't it? So I'll give a practical example from my experience in this actual time frame. Okay, so we have one property, and I was actually just looking at the numbers earlier today, so the example's fresh in my head. We bought the property in 2022, and the average rent at that time was $822. So here we are in August of 2024, a little bit over 2 years later. Our average rent is $1167. So we've increased rents more than 343 bucks on average. You would think that's pretty good, right?
Yeah, I would
I
think
think
so.
that's pretty good. It's probably the biggest one I've had at any of my properties.
Yeah.
Here's the problem. Expenses have increased more. So
Okay. So then
so
that's really
there's this
good.
little
So
thing called inflation that people aren't quite factoring into that part of the equation.
what were the expenses that wound up being a big chunk of that?
Great question. So with this particular property, unfortunately, it also happens to be in a coastal market. So one of them is insurance. Insurance is one of straight across the board, even in non-coastal markets. And I don't mean like up like 2-3%. I mean like 100% in some cases. But our insurance premium is something like 3.5 times the amount that I underwrote it for.
Wow.
So that hurts. We also have a floating rate loan because we used bridge debt. So when we first closed, the interest rate on that loan was 4.5. I'm going to tell you guys a secret. It's not 4.5 today. Matter of fact, it's in the 9s. Now we have a cap on that loan. So the cap brings us to, I think, 6.5. But here's the thing. When you're stress testing a deal, most times you're assuming that to be a worst case scenario. You're not assuming that you're going to run it that way every single month.
Yeah. Let alone the 3.5 times increase in insurance, because that's
Right.
not what you're running that on.
Right.
You know?
And then you're also seeing those increases in other expenses. So another challenge has been repairs and maintenance. Since the pandemic, especially, a lot of people who do that type of work haven't been as willing to do it. There's no incentive because other jobs are paying more and they're not doing this backbreaking work sometimes. So they're like, well, why am I going to do that when I can work at McDonald's and make the same amount of money? So people who would have done those little fixes, all of a sudden now you have to go out and get somebody who's going to cost you quite a bit more, and that eats away at the bottom line. That's actually probably the single biggest thing people aren't talking about right now in the multifamily space. People are talking about insurance, they're talking about interest rates. A lot of them don't really focus on, rents have flattened or went down in many markets, but expenses are still going up. So remember our previous example when we were saying, well, if you have that leverage And if the NOI stays the same, I guess you can still pay the mortgage. Here's the problem. If your NOI didn't stay the same because your expenses went up and your income didn't, or maybe they went up disproportionately, all of a sudden the amount of cash flow available to pay that mortgage may not be there.
Three things that you mentioned before, and I'm going to pause and let you recount them, that kind of got us into the place that we are right now with commercial multifamily properties. And can you recount what those three issues were?
Absolutely. So, so I would even say four issues, but they kind of overlap a little bit.
Sure.
So the first is that, and again, always clear in hindsight, people pay too much for property. So it's often said the one mistake you can't correct is paying too much. Once you do that, you can't go back and change it.
Right.
So unfortunately, just about everybody who purchased the property in the second half of 21 and most of 22 probably paid too much for it. The second thing is when you couple that with many of those people using bridge debt. So what does that mean? It means it's short-term debt, typically 3 years or less. A lot of times it has a floating rate loan. So for anybody who knows where interest rates were in 2021 or 2022, you probably know they're in a much different spot now. So that means that your mortgage payment is a lot higher than it would have been back then. And three, insurance premiums. The insurance market has changed substantially in the last, 20 months or so. And because of that, premiums have went up drastically in many markets, especially in coastal markets, but even in non-coastal markets. And the fourth is operating expenses have continued to rise while operating income, rents, in many cases have flattened or went down. So all of a sudden, people who are projecting, oh, I'm going to go in here and push the rents to this, haven't been able to do that because there's an affordability constraint in many of these markets. And people are at a breaking point. They simply can't afford to pay more because their wages aren't keeping up with the rent increases. But the expense increases on the properties are still there. So it's kind of a perfect storm. It's a perfect storm if you're a buyer, probably not if you're a seller. Let me rephrase
There
that.
you go. There you go. So then what are people doing now? Because there's blood in the streets, as some people would probably say. What's
Yeah, great question. Well, I think if you're a seller that has a bridge loan with a maturity this year or next year, it's probably a lot of hoping and praying. uh, Many of those sellers are trying to execute the business plan if they've been successful or unsuccessful at it. But the reality is the market's changed substantially since many of these deals were purchased. So even with the best efforts, sometimes the plan just may not be practical at this point, and you need to adjust. A lot of them are working out modifications with lenders. They're going to the lender and saying, look, I know my maturity is coming up. We're not in a position to refinance. We're not in a position to sell without taking a big loss. What can we do? And so far, a lot of the lenders have been playing ball. They've been saying, okay, we understand the market's changed. Let's see what we can do to work with you, and maybe we can give you another year and see where things are then. And the lenders have done that, for two reasons. Why? One, they don't really want to, most lenders don't really want to foreclose on a whole boatload of property. Some do, most don't. And what happens? Well, ultimately, then they're going to have to become the person or party responsible for that property until they can sell it. And if the lender is a banking institution, then it could also impact some of the ability to put money out there for new loans. So that's the last thing any lender wants to do is impact their future lending business. So the more deals they have that aren't performing, the greater that's going to impact their liquidity.
Got it. 40 minutes. Okay, so what does that mean now? Is there blood in the street? Is there still opportunity? Should we wait? Should we time the market? Should we wait for the Feds to cut rates again? What should someone who's looking to jump in do right now?
So, okay, and let me preface this and say this is not financial or legal advice, strictly my opinion.
We're not attorneys or financial
Right.
advisors at all. No.
Right. So there's two very different perspectives that I hear right now from speaking to a lot of people on a regular basis. I hear some people say that this is the worst it's going to get, and things will be a lot better 6 months from now. Most of the people that tell me that tend to be syndicators, a lot of which do have some bad deals. So maybe there's some hope in there that that's correct. Um, the other perspective I hear is that this is just the beginning. Things are going to get a lot worse. I tend to hear that perspective more from the finance people. That's from the lenders. That's from the mortgage brokers. That's from finance people even outside of commercial real estate finance. Uh, so it's almost like a tale of two cities where, depending on which camp people are in, it tends to align with their perspective. I'm a little bit different because I am on the syndicator side, but I'm also very bearish. So why is that? Well,
Okay. What does it mean to be bearish versus
absolutely
bullish?
great. Yep, it's a great question there. So if you're brand new to the investing world, bearish means that you believe the market's going to experience a downturn of some kind. Sometimes it can be short, sometimes it can be longer and more pronounced.
So you are a bear in this market.
I
Um,
am.
and why do you have that opinion?
So right now, I see a lot of lenders working with borrowers. And obviously that's I think good for a lot of things, right? It offers hope. But then the other part of me says, are we just doing that because it's a presidential election year? And what happens next year once there's no election? Because at some point, these lenders are going to want this money back. They are trying to work with borrowers, and ideally, if there's a path forward, I think again, they don't want to foreclose on a whole ton of properties. There are some that they're going to have to inevitably foreclose on because they're not going to have a choice. But even with that, there'll be enough. So they don't want to add more to that and become full-time property and asset managers. That's not their goal. Something else that's probably important to note is that many lenders greatly downsized their asset management teams after the last recession.
Why?
It's a great question. They probably started doing that somewhere around 2012. Maybe they figured the worst of the market was over, so they didn't need that for the time being. So it seems like a lot of these lenders aren't truly prepared to take back a ton of deals. Now, maybe over the next couple of months, the lenders that have particular exposure to these maturities, maybe you'll see some of them start bulking those departments back up and hiring to build those. So keep that in mind. So why am I bearish? Well, there's a lot of debt maturities, a lot. And the challenge here is that these aren't long-term debt maturities. Some of them are, but the ones with long-term debt maturities that have had 7 or 10 years, they're probably okay. Property values have changed substantially in that time. So that's something that, they probably have some equity there. There's a good chance that they've been able to increase, rents a pretty good bit in that time because they've had plenty of time and very favorable market conditions, except for the last 2 years to do that. So those guys are okay, most likely. It's the ones who bought in 2021 and 2022. That's where your problems come in. Because as Jonathan said earlier, a lot of these guys are assuming, oh, I can increase rents this much. I could, do all these great things. But unfortunately, the market's changed, and it's changed a lot. So because of that, some of those plans just simply aren't practical anymore. Even if you have the best of intentions, you can have the best of intentions. You can say, I'm going to do X, Y, and Z. But if the market's not there to meet you, you're going to wind up on the short end of the stick. And that's where I think we are for a lot of these guys. Then on top of that, there's also a lot of new supply coming online in many markets, particularly the Sun Belt region. So those markets are being inundated with new supply that's going to put downward pressure on rents, even more than there already is. And
Why
that
why would
coupled
that
with,
bring downward pressure by having a new asset, a new A-class building?
yep.
Because generally
So,
A-class buildings are by time. Classes of buildings
yep.
generally by time. So
So a lot of times you're going to see a trickle down effect. So what's happening with a lot of these A-class properties? So you're right, they're not direct competition with like a C-class property. But what happens is eventually the A-class property has uh, trouble getting the rents they were targeting. So most of them, similar to a lot of the multifamily operators who use bridge loans, they have construction loans maturing. And as bad of a position as bridge loans are in, construction loans are in an even worse position.
Wow.
So those guys are stuck between a rock and a hard place. So that means they're probably going to be slashing rents because they'll need to sell these things at discounts just to try and get them off their books and cut the losses. So now they cut rents. So that means the properties beneath them, the B class ones, maybe they're a little too close to the rents that the A's are getting. They need to cut rents. And then as the B's cut, what happens there? Well, now the C's are too close to the B's. So what do the C's have to do?
They have to cut.
Right.
So with a bunch of people cutting rents, that's the downward pressure that we're talking about. And so in the Sun Belts, now what is the Sun Belt, just for everybody else who may be listening?
Absolutely. So it's the southeastern region of the US, but it's probably a little broader than that. So a general thought is that it goes from Virginia all the way over to Arizona. So pretty much the entire southern US with the exception of California and, a wide amount of regions and states.
Gotcha. So then you're bullish that things are going to go down because of multiple factors. And so now, how is this impacting those who are at the bridge debt for 3 years, right? At the end of 3 years, they have to have a balloon payment. What's happening?
Well, there's only so many options. Option one is they've done a great job. They're in a position to refinance or sell and to exit. In most cases, that's not the case. That is very much the minority. Very, very much. Option two is they can do what's called a cash in refinance. The last couple of years, people have gotten used to cash out refinances, which meant they were refinancing from one loan to another, and there was excess cash that they were taking. Now it's going to be excess cash they're putting in. The problem is, in some of these deals, that cash could be 7 or 8 figures. So depending on the size of the deal, it can be very, very expensive.
That's very
So
expensive.
a lot of people don't have that cash. So that's an issue.
So they're cash in. So how does that work with other people that are already on the deal, right? You've got two classes of people generally. You've got a GP, which are the people who are leading the charge. They're managing the asset. They raise the money, whatever. And in raising the money, they have this second class of people called the LPs or the limited partners. So now this money that's going to be needing to raise 7 or 8 figures, it's not all coming from the GP, it's coming from the LP. I mean, how, everybody, the percentages have already been set. How do these percentages get rejiggered now that I'm having to put up more money than when I initially put up? How does that work?
Very messy, unfortunately. Um, and in some cases, the GP is doing it. I think a lot of groups are trying to put the cash up, but I guess if it becomes an insurmountable number, sometimes you do have to do a capital call. So most agreements have a they have a capital call provision that's usually going to include some type of language about how existing ownership is going to be diluted if somebody doesn't contribute to a capital call. And that will vary from deal to deal. So most of our deals, what happens is the person who doesn't contribute, they're not only going to lose a 1-for-1 ratio of what they don't contribute, they're going to lose 1.5 to 1. So the downside is they actually lose more than just the dollar for dollar amount. The incentive is that it motivates them, but the challenge in reality, especially if we record this, is that a lot of people have already been asked to contribute to multiple capital calls. So as that happens, there's only so much money to go around. So there's going to be somebody who doesn't have money to contribute to the next one, or they don't want to contribute to the next one because they don't see a path forward. And that's happening in a lot of deals.
So then they wind up saying, well, I'll take the loss, I'll take the L. And taking the loss and taking the L, does that mean that they have debt? Or does that mean that they just now have a loss that they can then write off on their taxes in future years?
Yeah, so for the passive investor, they're going to get a loss. So the good thing for them is that the loss in these deals is limited to whatever capital they they invest. So if they invest 50,000, the loss they're going to have is limited to 50,000. Now, that's pre-tax. Whenever a syndicator gives returns, they're always pre-tax. Post-tax, it will be different. So if there is some depreciation they took that they're going to have to recapture when the sale occurs, they may actually lose a little more than that because they may have to come out of pocket, which really seems to confuse people and upsets them because it's something that a lot of people don't talk about. For the people who are on the GP team and specifically the loan guarantors, the issue there is that you have a lot of issues. One, most of these loans are non-recourse, but every non-recourse loan has what they
what
call.
is non-recourse, just for everybody?
Yep, absolutely. So non-recourse means that there is a personal guarantee, but it means that the lender is not going to come after the guarantors for anything other than the property itself, as long as they don't trigger the bad boy carve outs. So I'll define that because I'm sure that's the next one. So the bad boy carve outs, those are clauses in any loan agreement that basically trigger fraud. And what I tell people in layman's terms is that it's okay to be an idiot, but not okay to be a criminal. So as long as you were not doing anything criminally wrong, those bad boy carve outs typically aren't going to be triggered. And but what's the risk? Well, a deal fails, even if it's a non-recourse loan. In most cases, is the lender just going to take it laying down? Probably not. They will probably investigate to see if there was any wrongdoing. And if there's any way those bad boy carve outs can be triggered. Why? Because the lender doesn't want to be stuck holding the bag for millions and millions of dollars.
Right.
Now, if they investigate, there's nothing they can find, then it is what it is. The property is their only collateral. But let's say they do investigate something and they find some type of wrongdoing, the guarantor or guarantors could ultimately be on the hook for any shortfall. And sometimes that can be millions of dollars. So it's an interesting world, but there's a lot of opportunities coming, I think.
So, okay. You're giving us the bad news. So
Yeah.
basically what happens is for those that had those short-term debts, we call them bridge debts, right? Bridge loans. Either they're going to have to, they've raised the rents, everything is wonderful, and then they can exit and, kind of move around scot-free, right? There's very few of those that are out there. The remainder has to do potentially a cash in refi instead of a cash out refi. That's where everybody is encouraged, strongly through that PPM that they signed. That's the private placement memorandum,
Yep.
to contribute because the property or the investment needs money in order to continue to move forward. And if they decide not to do that, then they will wind up having to be kicked out of the deal, correct?
Right. That's correct.
And if them being kicked out of that deal, their losses, say, to whatever they've invested, if it's been $50,000, then that's $50,000 that they'd be kicked out. But for a lot of these deals, there was the depreciation and bonus depreciation that happened, right? And they may get stuck with a tax bill because of that depreciation that they took as a result or was distributed as a result of that particular deal
Yeah.
where they weren't. And the bank may come back and do some recourse, which means that the communication that you've been doing, those that are doing what is that called, investor relations, right? And client communications need to make sure that all those communications are lock solid. How they acquired, those LPs, how they acquired the GP team, how they've been communicating with them on a monthly, quarterly basis, their distributions, their taxes, their K-1s, all of those things may be called into question because the bank will probably be looking for what happened and who's wrong, right?
100%. You nailed it. That
And
when
so
deals go wrong, they're going to look through everything. So you got to make sure you keep good records.
there you go.
Um, and something else I would also tell you, communicating to the investors. So the challenge with some of these things, even when you communicate, some of these things, people don't always understand them. So aside from just sending an email or even a video recording, whatever it may be, sometimes you need to reach out to people and have a one-on-one conversation with them.
Yeah.
And, I can say, unfortunately, there's one deal that we had a small loss on last year. I'm thankful it was just a small loss, because it could potentially have been worse. Um, we gave people about 95% of their principal back pre-tax, but post-tax, it wound up being about 90%. So what happened? Because a lot of the investors were saying, well, how why did the K1s show that we're making money? Well, unfortunately, even though there was an actual loss on the property, there when you take the purchase price and you subtract that from the sale price at the end, it does show a gain, and that's what the IRS is looking at. And there's also depreciation recapture. So the challenge is, unfortunately, between those things, you have a taxable gain, even though you actually lost money. So these are all things that don't get talked a lot about in the industry, but they're important things to understand because they do happen at times, and you have to make sure that investors are aware of them so they know what to expect.
Excellent. So you mentioned that there are, and I've got a couple more questions. I don't want to hold you too long. We've already been going for quite a while, but you mentioned that there are opportunities coming. So it's like there's this silver lining in the midst of all of this blood, doom, and gloom that you mentioned
Mhm.
is coming with respect to prices and properties. Talk to me about what opportunity you see that's coming.
So the opportunity I see, I very much do see this as a generational buying opportunity coming. Uh, while I am bearish, every bearish, move leads to a bullish move eventually. So I think the next 2 to 3 years are a great time to buy. Now, does that mean you should run out and buy today? I'm not saying that. I think it's good to be looking. I think it's good to be in touch, building relationships, making sure that you're ready to buy. And if you happen to see a great opportunity, absolutely jump on it. But if there's any doubt in your mind, right now is not the time to pull the trigger. You want every red flag to be waved. You want every green box to be checked. If it's an absolute can't miss deal, pull the trigger and run with it. If not, you'll see a lot of those over the next 2 to 3 years. It's taking time to happen, but keep in mind, commercial real estate's a slow game. If you want fast, you trade stocks because that happens real time. Commercial real estate is slow. Think of stocks like a sailboat and commercial real estate like the Titanic. It's not nimble. Even in the best of times, it takes you, 4 to 6 months to sell a property. So it takes that much longer for data to hit the news wire, because by the point the transaction sells at that lower price, you know, the market may already be doing something different because it takes time for that data to hit.
Yeah.
So there's a lot of opportunities coming. It's just being prepared, being in the loop so you're looking at these things. And if you see something, be ready to move fast because there'll probably be a lot of competition for deals that are actually priced right and make sense.
Got it. So then question, I've heard somebody say C-class deals is not where it's at right now, right? Generally, C-class deals provide the best opportunity for what we call value add, where you can go and fix them, right? Fix them up and sell them, or fix them up and hold on to them. Um, do you agree with that, or what are your thoughts?
Yep. So what I would say is his preference. So the kind of the general narrative within the industry, and the syndication space specifically, is you kind of start out with the C-class properties and then eventually mature to the Bs, and I hope to mature to the A, but some people don't have that desire. So the C-class properties, you can usually get the best dollar for dollar return. The challenge is that when you factor in like a risk adjusted return, maybe it's not quite as great because there's a lot more risk with delinquency. There's a lot more risk with crime. There's a lot more risk with things that go wrong. So, Jonathan, you mentioned the key term, value add, and that's been a buzzword in the industry for the last number of years. Here's the key component that most people forgot about with value add. You have to buy the property at a discount. And
Bingo.
unfortunately, in 2021 and 2022, nobody was buying anything at a discount. So,
So
so It's like buying a flip, but you're paying the retail price, then doing the work and hoping that you can sell for more. You know, most people in the single family space that I know don't do that. And in the multifamily space, for those doing value add, you don't want to be doing that either. But that's what was happening these last couple of years.
So if there's a C-class property that's out there right now, make sure that you're getting it at a discount,
Right.
right? And the best ways to know that you're getting it at a discount is to make sure that you are familiar with the market, right?
Bingo.
So you mentioned that markets are really important to learn and grow, and you're in the Charlotte market. Obviously, you like it there. What are some of the other markets that are out there that you've kind of got your eye on, or you think are going to, do better in the future?
Yeah. So the ones that I focus on mainly are in the Carolinas, Georgia, and Florida. And I do that just because of proximity. But in general, most landlord-friendly markets that have jobs in them and jobs coming to them are good markets to be in. There's the Midwestern markets are probably the best cash flow markets in the country. You won't see the swings that you do in some of the coastal markets, but you'll see a lot more stability. So I think after the last couple of years, you'll probably see a lot of people who appreciate stability more. It may not be as sexy when the market's hot, but when the market rolls over, there's something to be said for stability.
Got it. So then, with respect to, um, let's see, team. I think we talked about team. We started out on team, right?
Yep.
How has your team changed now moving forward? Or are you working on a team right now? I mean,
Yeah. So
building a
the
new team.
biggest thing that I know I'm always looking for is capital. And whether that's a stronger loan guarantor, whether it's a stronger equity partner, even just to go in there and, as you said, to put 5 or 10%, whatever the lender might require. If you do a big enough deal, those numbers add up very quickly. So finding stronger capital partners to work with is, for me, the single most important thing. And, different people have different strengths. My strength has always been more on the deal finding side. I can do that side of it pretty easily. I can run deals fairly well, but I've always been weaker on the capital side. So finding a really strong capital partner. Another thing I would also say is having liquid reserves. You can't underestimate the importance of liquid reserves in this business. You can have net worth on a balance sheet. Net worth doesn't solve problems. When you have a problem, you need cash. So finding very strong cash partners that have, you know, typically large amounts available at all times, that's what I want in team members,
So
because
then
that's
why
how teams
why
go.
why don't you underwrite those liquid reserves into the deal, right? Some people say another 20% management reserve is what you should put, from the rents or whatever as a part of your NOI calculations and underwriting calculations. Do you do that as well, or
So I usually do use a reserve, but the challenge when you're underwriting is that it's only an estimate. So you got to keep that in mind. And some of those estimates can be pretty close, but then there's other times where things don't go as expected. And sometimes you truly don't know certain things until you get into a property. You're like, oh, this is a lot more expensive than I thought. So you need to have that extra money, because if you don't, you can wind up stuck. And obviously, you don't want to be using that every single deal, but there will be times when you need that to weather a storm, so to speak. And the ones who will be fine right now are the ones who are well capitalized. So if they can come up with the seven-figure number to do a cash and refinance, they'll probably be okay. It's the ones who can't, which is a lot of, that'll be stuck.
now as you've been talking, it just clicked to me the answer to this next one for me personally, because I just thought about it, where I could go find these people, but where would you find those type of people?
So I probably wouldn't go to a lot of the conventional spots, multifamily conferences and things like that. And let me be clear, I like multifamily conferences. I've been to a lot of them. I do find some value in them, but that's not the value I find in them. So it depends on what you're looking for. So for those types of people, a lot of times they really come through more experienced industry connections. Um, you can go on LinkedIn. That can definitely be one way, but LinkedIn's kind of the equivalent of cold calling if you don't have any, a prior relationship or connection. Sometimes it can work, but there's some people who are just going to dismiss it and not truly look at it. So one of the things that I have actually been looking at recently is more like alternative investment conferences. I find that a lot of the people I want to meet probably go to those more than they go to multifamily conferences. Now, if you're brand new and you're starting out, it's probably good to go to some multifamily conferences because you'll still learn things, you'll still meet people you want to meet, but it depends on where you are in your journey and what you need. So for me, people I want to meet, I think, are more alternative investment conferences, and that's who I'm looking to target
When
at this
you
point.
say alternative investment conferences, are you talking about self-directed IRA type conferences or what?
So not so much that. A lot of times they're more private events. Now, some of them you will find online, but a lot of them you just got to start speaking to people and asking them, what are they going to? So I have some contacts who are a lot better off than I am, and I usually ask them what events they're going to. And some guys who run REITs, some guys who do different things. And I listen to them and I'm saying, I've never heard of that event. But the reason I've never heard of that event is because I haven't played in that space yet. And,
Absolutely.
and what I've learned is, okay, I need to start playing in that space.
Yeah. I'll give one free here for everybody who may be listening. As I understand, the Pitbull um, Finance Conference is a big one. Um, you find a lot of hard money lenders and other people who are in the finance space at Pitbull. I've know one or two people who play in that space. So you may want to go to a conference like that, see if you can go. That again, that conference is nothing but people who are hard money and who have money, who are interested in potentially becoming hard money lenders or conventional type financiers, et cetera, mortgage company owners, et cetera, and they do that. So just a thought. All right.
Yeah, that's something I'll have to check out.
Yep. So the last one question that we always have for everybody who comes on is giving us the boot. That piece of advice that you would give to anybody, everybody who's listening to what you've had to say, based on your wisdom and everything that you've learned. Give us the boot.
So this business isn't hard. Now, let me be clear. There's going to be a lot of failures for a business that's not hard. But the reason there'll be a lot of failures is because a lot of people went against the fundamentals. And this may sound simple, and we all have our own inclinations to do things our own way, but it really comes down to buying right, financing right, and being well capitalized. If you do those three things, you'll be very successful in this business, and also realize it's a long-term business. If you have an unrealistic expectation that you're going to make a lot of money in a short time, you're probably going to be disappointed. But if you set yourself up with the real expectation that this is a long-term business, you're gonna have to put some time, you're gonna have to put some effort, you're gonna have to put some money, you may have to lose some sleep here and there. You can make a lot of money as long as you stick to the foundations and adhere to them at all times.
Got it. So what are you doing nowadays? How can people get in contact with you? Give us your information. Give us your pitch now.
Yeah, absolutely. Well, what I would say is I'll provide you with my link tree so you can put that in the show notes. And in the virtual background, you guys might see Master Passive Income. So that's a brand that I've recently aligned with, and I'm very proud of that. There's three things I would say there. So one is we are going to be doing an in-person multifamily conference. So for anybody who listens to this, that conference will be in Denver, Colorado on November 7th, 8th, and 9th. So we absolutely encourage you to come, and there'll be a link for that in the link tree. We will also be doing what they call Rube Clubs, which is think of like a hybrid between meetup events and RIA events. And right now we're going to start them in a limited number of cities, Charlotte, North Carolina being one. So if you're local to the Charlotte market, that's going to be like a recurring monthly event and you want to attend, reach out. We're glad to have you. And then third, as Jonathan mentioned, every Saturday afternoon, I do a free underwriting session. And for everybody who wants to learn how to underwrite multifamily deals, we're glad to have you attend.
Wow. So I have been to a couple of those sessions in Charlotte, North Carolina. with Charles and his team and his crew, and they have been very, very valuable. Lots of good meeting and potentially meeting other people who could be on your team. Feel free to reach out to Charles. I trust him. I had to bring him on and have another conversation with him because he's always providing very valuable information. So again, as always, sir, thank you so much. And if there's anything we can do here to assist you, please let us know.
Excellent. Thanks, Jonathan.
Absolutely.